Welcome to our video on how to pay off debt fast, strategies that really work. In the modern world, debt has become an unavoidable part of life for many of us. Whether it's student loans, credit card debt, or a mortgage, it's essential to understand the importance of paying off this debt as quickly as possible. Why, you ask? Well, the faster you pay off your debt, the sooner you can achieve financial freedom, and who doesn't want that? But remember, it's not about rushing into it. It's about being strategic, patient, and persistent. Paying off debt quickly isn't a sprint, it's a marathon. It requires a solid plan, and that's what we're here to help with. In the coming segments, we will delve into various effective strategies that can help you tackle your debt head-on. So buckle up and get ready for a journey towards financial liberation. Stay with us as we explore effective strategies to help you become debt-free. Before we dive into the strategies, let's understand what debt is and how it affects us. In its simplest form, debt is money that you owe. Whether it's a mortgage, a student loan, or credit card bills, these are all forms of debt. Now, debt isn't inherently bad. In fact, some types of debt can even be beneficial, helping us achieve long-term goals like home ownership or a college degree. But where debt becomes a problem is when it spirals out of control, eating into our financial stability. This often happens when we start borrowing more than we can afford to pay back, or when we're not mindful of the interest rates attached to our loans. Speaking of interest rates, let's take a moment to understand their impact. The interest rate is essentially the cost of borrowing money. It's expressed as a percentage of the amount borrowed and is typically charged annually. So the higher the interest rate, the more you'll end up owing in the long run. Consider this: you borrow $1,000 with an interest rate of 5% per annum. At the end of the year, you'll owe $1,050. That's the original $1,000 you borrowed, plus an additional $50 in interest. Now imagine this on a larger scale, say a mortgage loan of $200,000, and you'll see how the numbers can quickly add up. This is why it's so important to keep an eye on interest rates when borrowing money. They can significantly influence the total amount you end up paying back. Now it's worth noting that not all debt is created equal. There's good debt and bad debt. Good debt is an investment that will grow in value or generate long-term income like a home loan or student loans. On the other hand, bad debt is something that quickly depreciates in value or doesn't generate income like credit card debt. Now that we understand debt, let's move on to the strategies to pay it off. Our first strategy is the debt snowball method. Now imagine a small snowball rolling down a hill. As it descends, it gets bigger and faster, right? That's similar to how the debt snowball method works. In this strategy, you start by focusing on your smallest debt. You make minimum payments on all your other debts, but you throw as much money as you can at that tiny debt. You're not concerned about interest rates at this point. Your goal is to clear that smallest debt as quickly as possible. Once that's done, you move on to the next smallest debt. The money you were using to pay off the first debt, you now add that to the minimum payment of your second smallest debt. It's like that snowball rolling down the hill, gaining momentum and size as it goes. Let's illustrate this with an example. Suppose you have 3 debts, one of $500, one of $1,000, and one of $2,000. You make minimum payments on the $1,000 and $2,000 debts while focusing on the $500 one. Once the $500 debt is paid off, you move on to the $1,000 debt, adding the money you were using on the $500 debt to the minimum payment of the $1,000 one. This process continues until all debts are cleared. The beauty of the debt snowball method is that it creates a sense of accomplishment. By focusing on the smallest debt, you can see progress quickly, which can be a huge motivation to keep going. It's like a psychological trick that keeps you focused and committed. However, it's important to note that while this method is effective, it may not be the best for everyone. If you have high-interest debts, you may want to consider other strategies which we'll discuss later. In summary, the debt snowball method involves paying off your debts from smallest to largest, building momentum as you go along. It's a proven strategy that can make the daunting task of debt repayment feel more manageable and achievable. The debt snowball method is a proven way to pay off your debts, starting with the smallest. The second strategy is the debt avalanche method. Imagine you're standing at the top of a snow-capped mountain. The snow is your debt, and the mountain is your repayment journey. The debt avalanche method is about tackling the highest peak first, the debt with the highest interest rate. It's like causing an avalanche that takes down the biggest threat first, then moving down to the smaller peaks. or debts, with lower interest rates. Now, how does this differ from the debt snowball method we discussed earlier? Well, the snowball method focuses on paying off the smallest debt first, regardless of interest rates, to gain momentum. It's about quick wins and psychological motivation. On the other hand, the Avalanche method is more about the mathematics of debt reduction. It aims at paying less in interest over the long run, which could save you both time and money, depending on your debts. Let's put this into perspective with an example. Suppose you have 3 debts, one for $3,000 at an interest rate of 20%, another for $5,000 at 15%, and a third for $2,000 at 10%. Following the Avalanche method, you would prioritize the $3,000 debt because it has the highest interest rate, even though it's not the largest debt you have. Once you've completely paid off the first debt, you then focus on the $5,000 debt, and finally, the $2,000 debt. Our third strategy involves using consolidation loans. Imagine having multiple debts, each with its own interest rate, due date, and conditions. It's like juggling flaming torches, and one misstep could lead to a financial burn. Consolidation loans are like a safety net, catching all those separate debts and merging them into a single, manageable payment. So, what exactly are consolidation loans? Simply put, they are loans that you take out to pay off multiple smaller debts. You're essentially trading many debts for one big one. But why would anyone want to do that? It's all about simplification and potentially saving on interest rates. Let's say you have 5 different credit card debts. It's hard to keep track of all the different due dates, and the interest rates are sky high. With a consolidation loan, you take out one large loan to pay off all your credit card debts. Now, instead of managing 5 debts, you only have to worry about one loan with a single interest rate and one due date. Sounds convenient, right? But hold on a second. Like any financial tool, consolidation loans come with their own pros and cons. On the plus side, they simplify your financial life, and they may come with a lower interest rate than what you're currently paying, especially if you have good credit. However, there are potential downsides to consider. If you're not careful, you may end up paying more in the long run due to extended repayment terms. Also, while you might be tempted to rack up more debt once your credit cards are paid off, remember that you still owe the same amount of money. It's just in a different form. Lastly, always be wary of companies offering consolidation loans with too good to be true terms. There's often a catch hidden in the fine print, like high fees or ballooning interest rates. Consolidation loans can simplify your debt repayment process, but remember to read the fine print. The fourth strategy involves balance transfer cards. Now, what are these cards and how can they help you pay off your debt faster? Well, as the name suggests, a balance transfer card allows you to transfer the balance from one or more credit cards onto a new card. This new card typically comes with a promotional period of 0% interest, which can range anywhere from 6 to 24 months. This means that during this period, every dollar you pay goes directly towards reducing your debt, rather than being eaten up by interest. Consider this as a pause button on your growing interest, giving you some breathing space to tackle the principal amount. It's like getting a head start in a race against your debt. However, it's not all rainbows and unicorns. There are a few things you need to be aware of when using balance transfer cards. Firstly, there's usually a balance transfer fee. This generally ranges from 3 to 5% of the total amount you're looking to transfer. Make sure to factor this in when calculating your potential savings. Secondly, once the promotional period ends, the interest rate can jump significantly. This can be a nasty surprise if you're not prepared for it. Therefore, it's crucial to have a plan to pay off the transferred balance within the promotional period. Lastly, opening a new credit card can temporarily lower your credit score. This is something to bear in mind, especially if you're planning to apply for a mortgage or a loan in the near future. All things considered, balance transfer cards can be a powerful tool in your debt repayment arsenal. They can help you save on interest payments and speed up the process of becoming debt-free. But like any financial tool, they need to be used responsibly. Remember, it's not about moving debt around, it's about moving towards a debt-free future. Balance transfer cards can be a great tool if used wisely. Our final strategy involves seeking professional help. Sometimes, despite our best efforts, we can find ourselves tangled in a web of debt that seems impossible to escape from. It can feel like we're sinking in quicksand, with each struggling move only dragging us deeper. When you find yourself in this situation, it may be time to consider seeking professional help. Professional help can come in various forms. There's credit counseling, where a trained professional will help you understand your finances and guide you on how to manage your debt. They can help you create a budget, offer advice on how to deal with creditors, and even propose a debt management plan. Another option is a debt settlement company. These companies negotiate with your creditors on your behalf to reduce the amount you owe. They can often get a significant portion of your debt forgiven. However, this route should be taken with caution as it could potentially harm your credit score. You could also consider hiring a bankruptcy attorney. Although declaring bankruptcy is a last resort, an attorney can guide you through the process and help protect your assets. The potential benefits of seeking professional help are many. For one, it can relieve the mental and emotional stress that comes with dealing with debt. It can also provide you with a clear path forward, with a plan tailored to your specific situation. Furthermore, professionals have experience dealing with creditors and can often negotiate better terms than you could on your own. However, it's crucial to do your own research before choosing a professional to help you. Make sure they are certified, have a good reputation, and understand your financial situation and goals. Remember, debt is not a life sentence. Just like any problem, it has solutions. And sometimes the best solution is to seek the assistance of a professional. It's not an admission of defeat, but rather a proactive step towards regaining control of your financial life. Remember, seeking professional help is not a sign of failure, but a step towards financial freedom. We've covered some powerful strategies to help you pay off your debt fast. Each of these methods, used wisely, can be a game changer for your financial health, but it's important to remember that they're not magic solutions. They require commitment, discipline, and a willingness to make changes in your spending and saving habits. Let's take a quick walk down memory lane. We started by understanding what debt really is and how it affects our lives. Then we dove into the debt snowball method, where we focused on paying off the smallest debts first to gain momentum and motivation. This strategy is perfect for those who need to see quick wins to stay motivated. Next, we explored the debt avalanche method, which is all about tackling the highest interest rate debt first. This strategy can save you a lot of money in the long run, but it requires patience and discipline as the results may not be immediately visible. We then discussed consolidation loans, where all your debts are combined into one loan with a lower interest rate. This strategy simplifies your payment process and can significantly reduce the amount of interest you pay over time. In the next strategy, we looked at balance transfer cards. These allow you to move your high-interest debt to a card with a lower interest rate, often 0% for a promotional period. This can be a great way to save on interest, but it's crucial to pay off the balance before the promotional period ends. Lastly, we talked about seeking professional help, which can be a great option if you're feeling overwhelmed by your debt. Credit counselors and debt settlement companies can negotiate with your creditors on your behalf to lower your interest rates or reduce the amount you owe. The journey to becoming debt-free is not easy, but it's definitely worth it. Remember, the key to successfully paying off debt is to pick a strategy that works best for you and stick to it. Commit to a strategy today and take your first step towards a debt-free life. Thanks for watching.